So one of the questions I've always had about investing is, why do people tend to start investing only during bull runs in the stock market? It's a behavior deep rooted in investor psychology, and understanding this psychology can help us better navigate the market more effectively. So in this video, we're going to be exploring the psychology behind investing during bull runs. Before we delve into investor psychology, let's clarify what a bull run is. In the stock market, a bull run refers to a prolonged period of rising stock prices and overall market optimism. Now, let's explore the reasons why people often choose to invest during these bullish periods. One of the primary psychological drivers is the fear of missing out. When investors see their friends, family, or colleagues making profits during a bull run, they experience a strong desire to participate and not be left behind. Fear of missing out can create a sense of urgency to jump into the market, even if it might not be the most rational decision. Another psychological factor at play is overconfidence bias. During bull runs, the market sentiment is generally positive, and investors may believe that they have a special ability to predict future market movements. This overconfidence can lead them to believe that investing during a bull run is a surefire way to make easy profits. Our minds are often influenced by recent events, and the stock market is no exception. During a bull run, positive news and rising stock prices dominate the headlines, creating a recency bias. Investors tend to give more weight to recent positive experiences and may assume that the trend will continue indefinitely, leading them to invest based on short-term market performance. Human beings are social creatures, and we tend to look to others for guidance, especially in uncertain situations such as investing. During bull runs, the market is abuzz with excitement, and the media often highlights the success stories. This herd mentality can influence investors to follow the crowd and invest without thoroughly evaluating their decisions. Optimism bias is a tendency to believe that positive events are more likely to happen to us compared to others. During bull runs, investors may develop an unwarranted optimism that their investments will continue to grow, leading them to take on more risk or invest more money than they would in a different market environment. Anchoring bias refers to the tendency to rely too heavily on initial information when making decisions. During bull runs, investors may anchor their expectations to recent market gains, assuming that the upward trend will continue indefinitely. This anchoring can cloud the judgment and lead to unrealistic expectations. The fear of regret can heavily influence investment decisions. During bull runs, investors may fear missing out on potential gains and regretting their inaction later. This fear can push them to invest, driven by the desire to avoid the pain of regret rather than a careful analysis of the investment's merits. Understanding these psychological biases can help us recognize our own tendencies and make more informed investment decisions. It's very important to be mindful of our emotions and take a rational approach to investing. So how can we navigate these tendencies? Here are a few tips to consider. Stick to a long-term plan. Create a well-defined investment plan that aligns with your financial goals and risk tolerances. Stick to your plan regardless of short-term market movements. Diversify your portfolio. Spread your investments across different asset classes and sectors to mitigate risk. Diversification can help you weather market volatility and reduce the impact of any single investment. Practice patience. Investing is a long-term game. Avoid making impulsive decisions based on short-term market movements. Stay focused on your long-term goals and resist the urge to time the market. Educate yourself. Continuously educate yourself about investing. Understand fundamentals of companies, analyze market trends, and make informed decisions based on research rather than emotions. Seek professional guidance. Consider working with a financial advisor who can provide objective advice and help you stay disciplined during market fluctuations. Remember, investing during bull runs can be very tempting, but it's crucial to remain rational and avoid succumbing to the pitfalls of investor psychology.